Hello, I'm Noelle Lim on ASEAN Speaks by Maybank Investment Banking Group. The headlines have been about Russia's full-scale invasion of Ukraine that has already cost more than 200 civilian lives, possibly triggering a new Cold War. What will be the impact of this conflict and sanctions on Russian companies on ASEAN? Our regional co-head of macro research, Chua Hak takes it from here.
Another roller coaster for markets last week. Markets sold off in the first half last week as Russian troops moved into Ukraine, but came roaring back in the second half as sanctions likely spared Russia's energy sector. So largely the sanctions were targeting the oligarchs and banks and were not seen as tough as originally feared. Though things may have changed this weekend. Markets reassess Fed rate hikes, lowering the odds now over 50 bips. US Fed rate hike in March, probably now 25, given the uncertain macro impact. For the week, the S&P was actually up slightly, 0.8%. Nasdaq was up 1.1%, but the Dow Jones slipped 0.1%. The futures are, however, down, currently about down 2% for the Dow. Nasdaq futures are down about 3%. European markets were weaker last week, with the stocks 600 down 1.6%, the DAX down 3.2%. MSCI Asia Pacific was also weak, falling 3.9% last week, and that's led by sharp falls on the Hong Kong, it's down 6.4%. That's to a 2-month low. Singapore down 3.9%, and Japan as well down 2.8%. Some ASEAN markets like Indonesia, Malaysia, Vietnam were pretty resilient, falling less than 1%. The Russian stock market collapsed by more than 20% last week, and the Russian ruble depreciated by more than 6%. Crypto index continued to sell off. That index fell 3.6% for the week. 10-year US Treasuries rose slightly last week, up 3 bips to 1.96%. But the German 10-year and UK 10-year both rose. Brent oil prices rose 4.7% during the week, but off their highs of almost $106 that was reached on Thursday. And note that OPEC Plus will be holding an important meeting middle of this week. So markets focus this week will continue to remain on the Ukraine-Russian conflict and any further possible sanctions. The conflict is not only a humanitarian crisis with over 150,000 refugees so far, but has also raised the risk of global stagflation and ended the post-Cold War peace dividend. Russia accounts for about 12% of global oil production and 17% of natural gas production. That's large, and any sanctions will likely cut off the supplies will send energy prices soaring. So broadening the sanctions to Russia's oil and gas could sink Europe into recession, and possibly drive energy prices closer to $150. European countries most vulnerable and reliant on Russian energy supplies are Hungary, Czech Republic, Latvia, Slovakia, Italy, and Germany, roughly in that ranking. Asia is a big net importer and will face collateral damage from rising energy prices. Russia is also a key supplier of industrial materials, metals such as nickel, aluminium, and palladium. Both Russia and Ukraine are major wheat exporters, while Russia and Belarus are big in potash, which is used in fertilizers. Russia is also a big exporter of coal. And palm oil prices might actually remain high because as a substitute for sunflower oil, because those supplies might be disrupted by the conflict. Ukraine accounts for 70% of sunflower oil exports. Russia accounts for about 20%. And India is a big importer of sunflower oil. Semiconductor production as well and supply chain might face some disruptions. Ukraine supplies 90% of US semiconductor-grade neon, a gas which is integral to the lasers used in the chip-making process. And Russia supplies 35% of the US palladium supply. That's a rare metal that's used to create semiconductors. That tech companies have already been facing problems securing chips, especially those used for cars and medical devices. One key new development over the weekend, which might impact markets this week, the US and Western allies will be placing sanctions on the Russian central bank and removing some of the Russian lenders from the SWIFT global payment system, which is deemed, that option I think to be deemed the financial nuclear weapon. This will mean that the Russian central bank cannot sell its foreign reserves to defend the ruble. And I think just looking at the black markets this weekend, the ruble is already down some 20% at black markets. Cutting off a 1.5 trillion economy may send shockwaves in ways that are unforeseen, and there will be collateral damage. Note that some banks in Italy, France, and Austria, that's UniCredit, SocGen, Raiffeisen banks, have low exposure to Russia and may be impacted. This comes on top of some of the sanctions already announced last week. The US Treasury Department sanctioned 2 of Russia's largest banks, State Bank, Sberbank, and VTB, as well as several smaller banks. VTB and some other small banks are also added into the US specialty designated nationals list, which kicks the banks out of the US financial system, bans their trade with Americans, and freezes their US assets. And separately, the British government has imposed an asset freeze on all major Russian banks and stopped major Russian firms from raising finance in the UK. Banks are also cut off from the sterling markets and clearing payments. Very sorry for the long overview, but there are a lot of developments to digest. So stepping away from the Ukraine crisis, other key macro reports this week will be the US Fed jobs report and Fed worldwide PMI. There are central bank meetings in Malaysia, Australia, and Canada. In the US, President Biden will be delivering his first State of the Union speech. That's on Wednesday morning Asian time, with his poll ratings currently hitting a new low. Fed Chair Powell will deliver his semi-annual report to the US Congress midweek. In Europe, there's prelim CPI readings are due for the Eurozone in Germany, as well as January PPI jobless rate and retail sales. In Asia, the spotlight is on China's People Political Consultative Conference on Friday, followed by the 5th annual sessions of China's 30th National People's Congress, which will start on Saturday and last for a week. Asia data out this week includes China ASEAN PMI, China trade, retail sales, and CPI. The situation remains fluid, and we will have some comments on our speakers today on the developments. Suhaimi will cover Malaysian macro and some implications from the conflict. Saktiandi on the historical impact on FX from past geopolitical episodes. Winson on a thematic report on Malaysia's SIN IPPO coal bonds. Thilan on the results wrap of the 3 Singapore banks and what might be the impact from kicking Russia out of SWIFT. Hunchin on his update on the quant portfolio strategy, and Sebi on the possible new tax measures in the Philippines. So let's kick off first for Suhaimi. Suhaimi, core inflation is picking up in January for both Malaysia and Singapore. You are raising Malaysia's inflation forecast. What are the drivers of inflation? And also, could you share what you think are the economic implications of inflation and growth from a protracted Ukraine-Russia conflict?
Good morning, Abin and everyone. I think for Malaysia at least, we saw the release of inflation data last week. Although headline inflation is to 2.3% in January from December's 3.2%, suggesting diminishing base effects after the return of inflation last year from deflation in 2020. Food prices actually remain elevated due to what you call the supply disruptions arising from monsoon season, causing the heavy rains and floods late last year and early this year. But at the same time, we are seeing a pickup in core inflation rate to 1.6% in January this year from December's 1.1%, and the average for 2021 of just 0.7%. For the time being, we see the core CPI acceleration being due to the pent-up discretionary spending and services demand effect due to the progressive economic opening. So we see increase in costs at restaurants and hotels and recreation services. There's also some perhaps pass-through of operating cost increase by suppliers and producers of goods and services to consumer. We kind of slightly upward our 2022 inflation rate forecast for Malaysia to 2.7% from 2.5% previously. As it is, we are already above official and consensus forecast for Malaysia's inflation. Official is looking at actually a slower inflation rate of 2.1% this year from 2.5% last year, and consensus is looking at 2.3%. The reason for the upward revision in Malaysia's inflation forecast for this year is due to what we see as continued elevated F&B costs, partly due to the lingering effect from the recent adverse weather condition, as well as the elevated food-related commodity prices. And in a way, our forecast is reflecting the upward revisions to the in-house CPO average price for this year to 4,100 ringgit per tonne from 3,200 ringgit per tonne previously. For the time being, capping the upside to inflation is obviously the assumption of continued blanket fuel price subsidies that we are still enjoying right now, plus measures by the government in terms of price administration and supply side steps, things like freezing the base electricity tariff for all electricity users in Peninsular Malaysia, starting this month until end 2024, and also the subsidy to poultry farmers, as well as the allocation for short-term imports of chicken. There's also, in a way, remaining slacks in the economy that contain demand pull and wage inflation risk in terms of negative output gap and the still suboptimal job market condition. However, we do acknowledge the fact that going forward right now, as a result of the Russia-Ukraine situation, the risk is what you call that of higher inflation and slower growth. This is largely due to the potential, number one, I think, Russia commodity supply shock. As you mentioned, have been earlier, Russia is a big producer, major exporters of energy and food commodity-related stuff, as well as some key industrial materials. And the other concern is, of course, a prolonged and escalation in the conflict over there can actually destabilize Europe. Russia itself is not big in terms of, for example, trade with ASEAN, with Malaysia, only around 0.5 to 0.6% of total ASEAN and total Malaysia trade. But if this whole event drag Europe in particular, then the impacts start to get more significant. I think in terms of ASEAN and Malaysia trade exposure to Europe, we are talking about 8.5% of total trade. So I think right now the main concern is the risk of higher inflation, lower growth, and certainly historically with regards to crude oil price, we have seen whenever there is conflict or war involving major oil producers, i.e. since 1970s, in present dollar terms, historically, crude oil price tend to increase to between $110 to $130 per barrel.
Finally, Indonesian government commented on Friday that fuel prices, which are currently controlled and heavily subsidized, may have to be raised. So do you think the Malaysian government will also have to increase fuel prices? How much actually is the current fiscal subsidy bill, and market prices, well, how much are they above currently the controlled subsidized fuel prices in Malaysia?
I think there's a chatter already whether or not the government of Malaysia can continue with current subsidized price of around 95 petrol and diesel at RM2.05 per litre and RM2.50 per litre. Those prices were set when crude oil price was, I think, around $60 to $65 per barrel, and against current context where crude oil price is around $100 per barrel, there's certainly big jump, risk of big jump in terms of fuel subsidy costs to the government, to the extent that there is also the possibility that the net budgetary effect of higher crude oil price in terms of higher revenue to the government is being offset by rising costs of fuel subsidies. I think at least at current crude oil price level, the currently subsidized around 95 and diesel price are easily RM1 per litre less than what it should be.
Thanks, Suhaimi. Let's jump to Saktiandi. So Andy, an interesting FX report on past currency reactions and how Asian currencies fared in past geopolitical episodes. I think the study included the 2014 Russian annexation of Crimea and the Iraq War. So what are the key takeaways from these past episodes?
Morning, Harbin, thanks. Yeah, so the table actually looks at the impact on the FX beyond 1 day into 3 months. What we think we can learn from this past episodes, and of course it cannot happen again, but each instance, but at one glance, I think most geopolitical events in the past saw definitely gold got bit, and then oil prices ended up quite mixed, even if it's an oil-related situation, and whether there were risks to supply is another concern. In terms of FX, whether it reacts in a knee-jerk fashion or sentiment drags take longer to materialize depends on the event flow accompanying each political event. So for Crimea's case, the impact for currencies were actually quite impactful for some of the emerging currencies, but actually quite limited, less protracted than before. But at that point in time, there were other circumstances such as the Fed rate hikes. At that point in time, the taper tantrums that materialized at that time as well. But one thing that we want to look out for is in terms of whether the situation now actually has some exceptions. But the different cases have different impact. For example, if, for the Brexit case, the immediate direct impact will be on the sterling. This time around, the ruble got affected the most. There was some impact, but in terms of safe haven currencies like dollar, yen, and all, they remain quite supported as well. What we want to look out for in terms of sentiment, in terms of financial channels, Russia's trade shares with most Asian economies are not significant, with the exception of China, which is 20% of Russian trade in 2020, and South Korea. But CNH or renminbi actually remains quite resilient. Actually, in fact, if you look at the impact, what we want to look out for next is in terms of one key channel of transmission on the oil front. Habin.
Yeah. So how is this, Ukraine-Russia conflict unique and different, I guess, from some of these past episodes? And which currencies do you think are most vulnerable, besides the ruble, of course, if the conflicts are protracted and energy prices keep on rising?
So I view this as two phases. If it's protracted for about 3 months, I think one key channel of transmission, first key channel of transmission would be the oil prices if conflict worsens. To some extent, this could lead to some differentiation in near-term FX performance among Asia ex-Japan FX energy importers such as the rupee and Thai baht could see more discernible drags if oil prices stay elevated. But oil-linked ringgit, for example, could be a tad more resilient. And then you see if it escalates more, it could induce US Treasury yields to see some support on dips, and it could lead to some decline in interim dollar yen as well. And then euro also will be impacted as well if the situation worsens and if the cutoff in energy supply from Russia actually impacts them as well as really sensitive ones. But then the second phase would be a bit more protracted beyond 2-3 months. It will impact growth, concerns about stagflation, concerns about economic recession, and it will hit a broader range of currencies in our view before all this actually worsens to a large extent. So even currencies in the region, even ringgit, might be impacted beyond that if that second phase comes on stream in the long term, if it affects trade and growth in general.
Okay. Thanks, Andy. Winson, you released an interesting thematic study on the Malaysian coal IPP bonds and whether this dirty energy or sin bonds, as you call them, are getting the cold shoulder from investors. So what are your key findings?
Hi, morning, Habin. Our thematic report focused on the coal independent power producers or IPP. So I'm just going to share 3 key findings. First, I will just give a brief intro on the sector, and second, what is the current credit pricing on the credit curve on coal IPP bonds, and finally, what is the outlook for the sector. So briefly, for Malaysia power generation landscape, as we know, there's still a heavy reliance on fossil fuels. Coal and gas account for almost 3/4 of the installed power generation capacity in 2020. But in line with the global decarbonization effort, Malaysia government has already pivoted to renewable energy in recent years. And as far as we are aware, no new bonds have been issued to fund new coal power plants since 2015. But having said that, if you look at the total outstanding bonds for coal IPP, that's still pretty sizable at about 22 billion based on our compilations. Presuming no more new supply going forward, the total outstanding is expected to decline from 22 billion currently to about 17 by 2025, 10 billion by 2030, and complete the runoff by 2038. So coming to the second point, what is the current credit pricing? Domestic investors penalizing coal IPP heavily because it is a dirty energy sector. I would say the short answer is no. If you look at the current credit curve, the gas sector is actually the tightest, followed by the coal sector, while the solar credit curve actually trade a lot wider. That means the cost of borrowing for solar IPP bonds is actually still higher than coal IPP. So why is it the case? We know that ESG is a key factor, but it's not the only considerations. When it comes to credit pricing, investors still need to look at the credit profile of individual issuers. For example, the gas and coal IPP, typically they have established track of record, strong project sponsor like TMB, while solar IPP, they are relatively new not so established sponsor. And many of the projects are still under constructions and some encountering delays and issue. And if you look at the credit rating, right, the median rating for gas and coal, they are closer to AA1 or AA2 as compared to AA3 for solar. So there's a gap of 1 to 2 notches. So, and the final point, what is the outlook? I think a pertinent question is really whether coal IPP will eventually converge to sin sector pricing, which we reckon is debatable. What we mean by sin sector pricing is, for example, if you look at the Genting curve, it is a sin sector. Even before the pandemic, the bonds were actually priced at least 1 notch wider compared to similarly rated peers. I think that is such a possibility.
So that's rather depressing, Winson, despite all the ESG talk from banks and investors. So do you think Malaysia's market or investor reaction is to dirty or coal energy bonds is different from the rest of the world? I suppose, what are your views on the longer term trends and implications for credit and portfolio strategy?
In other parts of the world, for example, the Europe, as we know, it is the one of the strictest regime. So we understand that even the oil and gas names, they are probably having difficulty or slowly losing access to investors in the region. But of course, outside Europe, let's say in the US, especially in Asia, certainly there's still investor demand. For example, I think a couple of months ago, there are 2 names. One, the Shandong Energy Group, and also the Yanzhou coal mining. They managed to raise funds from the dollar bonds at competitive rates for their ratings, just I think back in December last year. So coming to credit strategy in Malaysia, a ringgit bond, I think there are a couple of considerations. One is liquidity. If the pool of investors continue to shrink, even though investor will get repaid eventually because of credit profiles are strong, but they might need to be prepared for a lower liquidity and hence a larger liquidity premiums that they need to pay when it comes to the secondary market. The second is the relative value, because when we look at the pricing, right, solar currently is still a lot wider than coal, but of course, as we mentioned, fundamentals make a difference. So eventually, I think the gap will narrow, and perhaps, let's say, the pricing, because of higher credit pricing, discrimination against coal credits. So I think the gap will actually narrow between these 2 sectors. And finally, within coal IPP, we actually prefer short to mid durations, considering a shorter time frame on policy uncertainties.
Thanks, Winson. Thilan, all 3 Singapore banks have reported their 4Q earnings results. So what are the key highlights and takeaways?
Morning, Hak Bin. Yeah, the results are good, but no real standouts. But the main difference is the level of upbeatness in guidance. All are guiding for higher loan growth in the 8 to 10% range for this year, and higher NIMs as well, which we think could increase 8 to 18 bips based on our in-house assumptions of about a 54 bip increase in SORA. Most are also guiding for higher double-digit fee income growth led by wealth management, IB&A, as well as rising transaction, credit card, and loan fees. A lot of this is predicated on regional reopening and Fed rate hikes coming through. Of course, asset quality remains a key concern, especially exposure in China and North Asia, as well as some of the Malaysian and Thai moratorium loans. At the same time, I think OPEX can be a negative surprise, especially on employee costs, because that seems to be very, very tight at this point, as well as increased technology costs from rising digitalization and cybersecurity. We think, after 10 years of operating in a low rate environment following the GFC, these banks actually now have the potential to structurally deliver higher ROEs going forward. Hak Bin?
So Singapore banks' share prices have rallied strongly the last several months, although there was some pullback last week. What's your relative preference now amongst the 3 banks post-results?
Yeah, we like UOB the most, largely from the regional reopening. I mean, they're geared towards ASEAN more, and then they also enjoy higher margins on the SME book. This is followed by DBS, given the very, very low cost funding base that they have. And finally, it's OCBC. We think the ROEs can be a little bit more squeezed given the very high CET1 ratios that they're carrying.
I want to bring in about the impact from SWIFT, because it looks like the US, UK, Europe, and Canada are now moving towards the nuclear option of blocking the Russian central bank and some Russian banks as well from the SWIFT system. What are the implications, any systemic risks? Which countries or banks could be hit? And any exposure or any risk to ASEAN banks in general?
Yeah, I mean, I think the key here is that the SWIFT ban is only against some unnamed banks at this stage. So it's not an outright lockout. So it's very hard to actually say, to quantify what the overall impact is going to be. Having said that, it does make it difficult for importers and exporters to transact with Russia. We think the systemic risk is largely in the EU, where Russia is a very large trading partner. In ASEAN, imports to and from Russia make up less than 1% of trade for the ASEAN 6, with Singapore and Philippines amongst the lowest. And if you also look at the imports, most of them are petroleum products, which we think it's quite easy to find alternative sources. The higher energy prices, given the disruptions that we're seeing, I think is a bigger systemic risk to ASEAN and particularly the banks, because this can squeeze margins and increase the risk of NPLs.
Okay, thanks, Thilan. Let's bring in Hanchin. In your latest quant portfolio strategy report, value and low volatility reign, what are the main highlights and what would you be watching out for? And what kind of strategy would you be recommending from here on?
Morning, Hak Bin. Since launch of our model portfolios, 75% of them have outperformed their respective benchmarks. This was due to year-to-date strong gains in value and low volatility strategies. Value strategies were led by Chinese financials, Chinese energy stocks, and Thai stocks, while our low volatility model portfolio was really boosted by Malaysian plantation stocks. With heightened inflation fears, we are closely watching US 10-year real yield, nominal yield, and inflation expectations. Based on the historical trend and the fact that Fed is increasingly hawkish, we see that inflation expectations may have peaked November last year. But on the front of nominal yields, we see the risk of further increasing due to Fed tightening. And the implication of this is there will be an increase in real yields. With an increasing real yield environment, we look at a correlation of stock market returns, investment style strategies returns, and sector returns versus changes in real yield. And we find that stock market returns and changes in real yield are negatively correlated, which in general, it means that stock market doesn't like an increase in real yield. ASEAN stocks, except for Indonesia, being less sensitive to changes in real yield. Value and high dividend strategies tend to be more resilient, while growth and momentum is more vulnerable under an increasing real yield environment. Similarly, on sector financials, industrials, energy tend to outperform, while tech should underperform under this scenario. Since year to date, we have seen a strong rebound in value. We looked at past 25 years of history in Asia Japan value versus growth. And basically, it can be split into a few different periods where during the tech bubble, we have a growth outperformance of more than 40%, while from year 2000 until year 2012, value has outperformed more than 150%. Then from 2012 until year 2020, growth has outperformed for more than 110%. And finally, we see the current ongoing value rotation where the outperformance has been more than 20% since it started in October 2020. We think that the rotation still is sustainable because we are under a rising real yield environment where value tends to outperform growth. And this is also a major rotation which follow after an extended period of strong growth outperformance, with the valuation discount still seen as attractive versus the long-term average. And finally, we prefer Asia ex-Japan stocks as compared to US stocks because China's forward PE has moderated from 17 times a year ago to 12 times now, and the relative forward PE of Chinese stocks versus US stocks has actually fallen below 1.5 SD of the 3-year mean, which is end of last year, which historically has been quite a good entry point into Chinese stock markets and also Asia ex-Japan stock market.
So Anshin, just quickly, any implications on your portfolio strategy if the Ukraine-Russian conflict drags on and energy prices keep on rising?
Yep. If the conflict drags on, growth concern will certainly come back into picture, and the risk is that the Fed cannot be able to tighten as aggressively despite rising energy prices. And the implication would be inflation expectations will rise, bond yields could take a breather, while real yields could actually go lower. And in this case, energy sector will still continue to benefit from rising energy prices, while growth stocks could actually stage a strong rebound due to lower real yields. But we prefer not to chase too much into the growth, into the rebound in growth stocks, because eventually Fed will have to tighten aggressively and the value rotation will still continue.
That's interesting. Thank you. Sevi, looks like the Philippines is also going to follow on the footsteps of countries like Singapore and Hong Kong and raise taxes on property to cover the fiscal shortfall. So what are some of these possible new property tax measures?
Right, as quid pro quo for the coronavirus response, which amounted to about 570 billion, the Philippine government is looking to raise new taxes, and two of the taxes that are relevant to the property sector are first, real property valuation reform, and then second, the removal of value-added tax exemptions. So in terms of the real property valuation reform, they're looking to standardize the base or the valuation for real property taxes, which is currently about 1 to 2% of property value. This will mostly affect areas where zonal values haven't been updated in a while. And then the second part is the removal of value-added tax exemptions. Currently, there's a number of exemptions in products like agriculture and medicine and low-cost housing. So they're looking to remove those exemptions to augment the existing revenue base.
Which sectors or companies will be hardest hit from these new tax measures?
Right. So our view is actually that the mall segments and the mall and hotel segments of the property sector will be most affected by these potential new measures. On the real property valuation reform, we don't expect this to be to make a significant dent, as it's not all encompassing. Only areas with outdated zonal values will be affected by this. But the removal of value-added tax or VAT exemptions, that can cause a dent on consumption or cause a deceleration in consumption. We saw this in 2005 when value-added taxes were expanded. And so consumption, especially in more discretionary segments like restaurants, like furnishings, and other miscellaneous consumption items, they saw significant deceleration versus 2004. So we think that the malls and revenues, the mall and hotel revenues will be affected. We think meanwhile, residential development should be intact, given that low-cost housing only accounts for less than 12% of pre-sales.
Okay, thanks, Sevi. That's all we have today. Have a good night.
Talk to your trading rep and download our reports from Maybank Trade app about what was discussed. And if you'd like to be updated on new episodes of our podcast, follow us on Spotify or Apple Podcasts. Have a good trading week and stay well. I'm Noelle Lim on ASEAN Speaks on Maybank Investment Banking Group.